Hey YouTube, Jason here with DayTradingFearless. Welcome back to my channel. And as always, if you're new, welcome. And make sure you guys hit the like and subscribe button to my channel. I appreciate that. Thank you. So as always, let's jump right into it. So yesterday I did a video on what a call is and showed you kind of how to use the Thinkorswim trading platform. So this time we're going to talk about what a put is, and also show you another couple tricks with the Thinkorswim trading platform. So today, puts. What is a put? Usually whenever you buy a put, you want the stock that you're looking at to move lower. If you sell a put, you want the stock to move higher. So a really good, easy example is this. If on the call side, okay, if you buy a call, you want the stock to move up. If you sell a call, you want the stock to move down. On the puts, if you buy a put, you want the stock to move lower. And if you sell a put, you want the stock to move higher. So why would you sell a put? Well, for multiple reasons, okay? Maybe we'll look at Apple, okay? If I actually look at the chart and I think Apple's up at a resistance level, instead of getting short the stock, I might go, hey, let me leverage my funds, my money, and buy a put. I could buy with 9 days left, okay? I could buy the 300 puts for $5.70. Multiply that by 100, that's $570, okay? Because one option represents 100 shares of stock. Now, easiest way, take this number, your strike price, add whatever you pay for the put. So 300 plus 575. So your break even on the downside, and in this case we would subtract that, right? On the downside would be 294.75. So watch. I click that. Okay, the 570. Okay, I'm going to buy the put. Right here we have 294.30, not 70. Okay, so our break even is $294.30 on the stock at expiration. So come expiration, if the stock is trading at $290, I will make 290 to 294.30, which would be $430. Okay. And that's if I want the stock to move lower. Now, when would I ever sell a put? Well, let's say I'm bullish on Apple, okay? And let's say I'm willing to buy it in the next 9 days if Apple pulls back to the 285 level, okay? So I would come over here, left click on the bid. Okay, and let's say it's worth $1.60 to keep numbers rounded. What I'm saying is, hey, if Apple is at 285 or lower, I'm willing to buy 100 shares of Apple. Well, if we go to confirm and send, we could actually see break-even stock price would be 283.40. Well, how did we come up with that number? Well, if we take 285, we collect $1.60 worth of premium, okay? We add that or subtract that to that, we will get the 283.40, the strike to what we sold it for. So essentially, Apple's at 301.70 right now. I could be wrong by about $18 on this stock by expiration, and I could collect that whole $1.60 that I sold. Now, my max loss is the stock could go all the way to zero. Remember, I actually have unlimited losses, okay, all the way down to zero, because if the stock, I have to be a buyer of 100 shares at 285 plus the 160 that I collect, my break even would be 283.40. Anything below that, I start to lose dollar for dollar. So if news comes out on Apple and they're now trading at $250, I'm down $33.60 per one contract, which would be essentially $3,300, okay? So you got to kind of be careful not to sell too many, because you have to realize you're going to have a lot of risk if you are actually wrong. Tim Cook dies, anything like that, you could get hurt very badly on this and blow up your account. Also, the thing with why would you want to also sell an option? Okay, look, you want to sell an option if you're bullish on the stock. Let's say I think Apple's going to 305 in the next couple days. Well, I could sell this 285. And how much do you think this option is going to be worth if Apple goes to 305 today even? Let's say I want to day trade this for a day or a couple days, right? So what we want to do is make sure you have Theo price here, right? It's under options, theoretical, and just click on Theo price. And then what we do is we click this box and bring it down. Now we can manipulate the date. How far out do we want to go? This is when the options expire, the third Friday, right, of every month. So let's say Apple's at 302 even right now, right? Let's say we think it's going to rally $3. So we're going to go 3.00. Okay, adjust volatility. Chances are volatility is not going to move up or down within the next $3 move. So we're going to leave that for right now, and then we press enter and we go and look at our Theo price. Okay, what this Theo price is telling us is if Apple rises plus $3 to 305, these options that we sold earlier for $1.60 will now be worth about $1.08. Well, that would be about a 50-cent move. Not bad, right? It's not a bad gain off a $3 move. And we're okay with that. Okay, we're okay with the price going up to, or with that trade, meaning what we sold for $1.60 is now worth $1.07. Okay, we're gonna make a nice 53-cent profit. Now, volatility, watch this. So let's just say for whatever reason volatility started to go up. That number went from 32 to 35 or something, right? But let's just move this up 1% even, okay? Look at what just implied volatility does to the option price. The same $3 move, we're exactly where we're at, plus 3 to where we go. Just that 1% implied volatility move of 32 to 33, we'll say, will add about 10 cents of value to make it more expensive. Let's say add 10%. Well, look at that. The stock doesn't even have to move, right? So we could go, hey, even if the stock didn't move, but all of a sudden there was news or something happened and implied volatility went to 10%. Dude, these same options would be worth $2.81. So even though the stock didn't move, nothing ever moved, we would have lost about $1.20 or so. Okay, so understand implied volatility, but understand selling options. Keep it simple, keep it basic, and be careful. Trade small. Don't get too big to where one bad trade wipes out 50 good trades, okay? But this tool could really help you of, hey, let's say we want to buy the 300 puts for $5, right? If the stock on, let's say by next Tuesday, the stock is down minus $5, okay? From where we are, how much is this 300 call going to be worth? Well, we paid five and a quarter for it. Well, if the stock moves down $5 by next Tuesday, okay, today's Wednesday, so we're looking at a whole week, okay? Yes, we're correct on the direction, but the option is only worth about $5.50 because of time decay. So what happens is, yes, we were correct by $5, but with that being said, we only made about 25 cents on the trade itself. Now, let's look at the same scenario. If we sold right now for $1.50, okay, the puts, and the stock drops $5, where, remember, if we're selling a put, we're bullish on the stock. We want it to go up, but we could still be dead wrong and still make money. Well, look at this. Stock is now trading at 297, okay, by next Tuesday. Well, yeah, we're wrong on the direction, but look at that. We've actually made money because of time decay and had a wide enough, or we sold far enough out of the money. So what we sold for $1.50 is worth 75 cents. Now, maybe you say, hey, let me cover it over the next couple of days and take my 75-cent profit and move on. Or remember, 75 cents would be a multiplier of 100, so $75. So I hope that helps. This has been what puts are and how to trade them, with a couple tips and tricks on the Thinkorswim trading platform. And as always, thank you for watching. Until next time, we'll talk to you soon.